5 vital keys every married person should know before signing any credit application. Brought to you by CreditSecretsBible.com. Have you ever wondered if banks have a tendency to approve credit cards and loans for one sex more than the other? If you're married or plan to be, we'll share with you 5 vital keys every married person should know before signing any credit application. Vital key number 1. According to the Federal Equal Credit Opportunity Act, or FECOA, creditors cannot deny consumers access to credit because of their sex. However, on average, in surveys, it's reported that women earn less money than men. Regardless of what the FECOA states, the relationship of credit to income is very strong. In our society, if you make less money, you will get less credit, period. The sad fact is that women on their own have less access to credit. It's for this reason we believe it's imperative that women learn and acquire more knowledge about credit than men. Knowledge is power, and in the world of credit, that knowledge will oftentimes prove to be priceless, especially for women. Vital key number 2. If you're a married woman with joint credit, meaning all your credit accounts are jointly held with your spouse, you essentially have no credit yourself. Many women in America find this out the hard way every year when they get divorced and lose all their credit privileges since all their accounts were jointly held with their spouse. If you're a woman in this position, you can greatly benefit by beginning to build your own credit in your own name starting today. The benefits of this are twofold. 1. If your spouse has financial difficulties for any reason and is forced to file bankruptcy or their credit becomes derogatory, you and your spouse will have your credit in reserve to survive on. 2. If you ever get divorced down the road, and over 50% do, you will not end up in financial hardship due to no credit and or derogatory credit. Instead, you will have your credit to transition to, and this can be the difference between sailing off in the sunset or drowning in a storm. Vital key number 3. If you are currently married with some credit or no credit to a spouse who has excellent credit, you can leverage their credit to build credit in your own name much faster than if you had to build it by yourself. Later, once you have established enough accounts on your own, you may choose to cancel accounts that were held jointly with your spouse. Vital key number 4. If you are a single woman with excellent credit and are getting married, you may want to think twice about adding your new lover to all your credit accounts. If he messes up or you end up in divorce down the road, your credit will end up taking the beating, regardless of how many years you diligently spent building it up. For this reason, we strongly suggest married couples keep their credit separate. Why? In most cases, spouses have far more to lose than to gain. Naturally, some credit will have to be joint no matter what you do. If you purchase a home, which may require both incomes to qualify, this will appear as a joint account on the credit report. However, the potential abuse with a home mortgage is almost always non-existent as opposed to credit cards. Vital key number 5. Spouses have more to gain by each building up strong individual credit reports rather than joining all accounts and building one joint report. For obvious reasons, banks and credit card companies love the credit ignorance of spouses who join all their credit accounts upon marriage. Here's why. If you take 500,000 couples with credit before they got married, those 500,000 couples actually represent 1 million credit accounts and liabilities for the banks and lenders. When those couples got married, those 1 million credit liabilities were instantly cut in half, from 1 million to only 500,000. For banks, this is a very advantageous situation. For the couples getting married, if they have financial trouble, the deal is a little raw. If they have trouble, although they are two people, they are represented by only one credit report. The bank now has the right to go after two different people for one account, regardless of who was financially negligent. For a moment, let's play out the same scenario with a couple which is financially savvy. Note, they're both on the same team, but just financially savvy. In this scenario, the couple gets married, but instead of joining accounts, decides to each build their individual credit reports. Now this couple or team has not one credit report representing them, but two. Metaphorically, if the perfect storm, financially, is to rise, this is the difference between the couple being in the ocean with two ships instead of one. If one ship starts to sink, the couple can always jump ship to the second one. While some may criticize this thinking, it is no different than buying any kind of insurance. You buy insurance not because you plan on a problem. You buy insurance because you are thinking ahead. This type of thinking is no different. However, if you want to be ahead of the pack, then you need to think ahead of the pack. We cannot tell you how many times we have talked to loving married couples in financial trouble who only wish they would have known about these 5 vital keys before they got there. Take them, study them, apply them to your life. As we heard one woman put it, in business and in life, I've learned to expect the best, but plan for the worst. We thought her words were brilliant. However, we have found that when we expect the best, many times we tend to get it. Take these 5 vital keys, study them, apply them, then pass them on to someone else who can benefit from them as well. This video has been brought to you by Consumer Publishing Group and the Credit Secrets Bible. For more information, feel free to visit creditsecretsbible.com.